Crisis refers to a difficult process, a period of depression that involves uncertainty, the possibility of being harmed, in the life of an individual, a group, or society. Recession, the decline in real GDP due to a decline in economic activities of a state in at least 2 quarters, a stage of pause and contraction in economic activities. Inflation, a continuous increase in the general price level of goods and services. Deflation, also referred to as negative inflation, is the continuous decrease in average prices. Real sector crises, contraction in production or employment in the field of goods and services. Financial crises. Financial crises are the result of the sudden depreciation of more than half of the assets in the financial sector. Devaluation, the reduction of the value of a country's currency against foreign currencies. Speculative movements, attacks in periods of devaluation expectations. Investors take large amounts of debt over the national currency, convert it to other currencies, and when devaluation occurs, they return to the national currency and make profit. Cold War is the period when the bipolar system, in which the US and the Soviet Union were prominent in the international system, after the Second World War. Strict monetary policy, the policies of the central bank in a country to narrow the volume of money in the economy. These policies are applied if there is excess demand in the country's economy. Globalization, in the international system, globalization means that the economic, political, and cultural elements of states extend beyond the national boundaries, spread around the world, and facilitate and increase the political and economic interactions between states. Fixed exchange system, it is the system where the central bank interferes with the foreign exchange, prevents the decreases and fluctuations, and tries to keep the exchange rates in a stable balance. Hyperinflation, this is the type of inflation in a country where the inflation rates reach to 3 or 4 digits per year. Moratorium, the borrower declares that they cannot pay all or part of their debts due to the loss of their ability to pay. Convertibility, it means that a country's money can be converted to gold or to other countries' money under a measure called exchange rate or parity. The global economic crisis. The concept of crisis that is based on Greek origin refers to the uncertainty in the life of a society, the possibility of harm, a risky and difficult process, and the period of a depression. The economic crises, which are classified into 2 categories in the literature as real sector crises and financial crises, are emerging in different dimensions as national, regional, and global, depending on the events and problems experienced. Factors that create real sector crises are the decreases in production rates seen in the goods and labor market, and increases in the unemployment figures. The global economic crisis. Financial crises in the financial sector, which include banks, insurance companies, leasing, factoring companies, mutual fund management companies and so on, are defined as financial crises. These crises cause disruption of the functioning of the global system, and the inability of governments and institutions to pay off their debts. Financial crises have both their common characteristics and their unique characteristics. The financial crises in all dimensions from national to global are analyzed. The findings of these analyses and the early warning systems formed by the results, in other words, the indicators of financial crisis lead the states. However, the use of these early warning systems that help us to anticipate the crisis and take necessary measures cannot fully eliminate the negative effects of the financial crisis. Financial crises are also divided into different types. Since these crises have successive and interrelated characteristics, it is not possible to distinguish the types of crises from each other completely. Based on a generally accepted approach, financial crises can be grouped under 4 categories: monetary crises, banking crises, systemic financial crises and external debt crises. In order to determine the factors that caused the financial crises especially in the 1990s and to explain their effects, various crisis models were created in accordance with the structures of the crises. These are the first-generation models, the second-generation models, and the third-generation models. Some models show justification for disturbances in purely economic indicators, while other models have discussed speculation and expectation variability as justification. As a matter of fact, each model tried to explain the new crisis by eliminating the shortcomings of the previous model. The global economic crisis in the historical development process. Global financial crises have a long history. While the Western states that realized the Industrial Revolution were able to establish their production structures, establish their own markets, and regulate economic infrastructure, they also faced economic crises. The World War I, which took place in the early 20th century, caused global financial crises in the international system. The states that entered this war faced very heavy costs because they lost most of the resources available in this process. This war has triggered a huge financial collapse worldwide, particularly in regions where non-personal market transactions are effective. It was a period of stagnation after the First World War. This period was followed by crisis and uncertainty. While the European states were trying to repair the destruction that this war had left, the US continued to improve itself in every way and played a major role in the restructuring of countries in the post-war period. This rapid development had brought with it an expanding credit volume. The country's bank structure had become extremely fragile due to speculation and bad loans in real estate. In 1929, this situation led to the collapse of the New York Stock Exchange, and brought along the Great Depression. The crisis of 1929 started with the decline in stock prices, and the crisis spread rapidly to many countries as a result of the stock market collapse. The world economy had faced major problems in a short period of time. In addition to the environment of risk and uncertainty, as the economic indicators came down, the world economy was dragged into a vicious circle. In this period, governments maintained tariffs against foreign competition and gave priority to economic regulations. Between the two wars and after the 1929 crisis, the import substitution policies began to be widely used in surrounding economies. As the World War II continued, the US created the Bretton Woods system to remobilize and stabilize world trade. Thus, the foundations of the international monetary system based on the dominance of the dollar were laid. After the World War II, as a result of the reconstruction of the European economy and the economic development through the formation of the multilateral world trade system, it's considered as the golden age between 1945 and 1970. In this period, capital inflows, especially foreign direct investments and aids, increased significantly. In the 1970s, the financial crisis in international markets caused the Bretton Woods system to collapse. In addition, the major oil crises that took place during these years had caused global economic problems and disrupted the global balances. With globalization, international trade has become widespread after 1980. The international mobility of financial capital has increased. The borders of the countries have almost disappeared, and any development or problem in a country has affected other countries rapidly. As a result, financial crises have started to increase in both developed and developing countries. After the 1990s, when the capital movements increased and the financial globalization process was completed, there were many financial crises in the developing countries and the transformation economies such as Russia. Global economic crises in the world and in Turkey. In the 1980s, both developed and developing states started to implement new policies in the economy in order to liberalize their financial systems. The main objective of these policies was to accelerate the economic growth. By the 1990s, these policies had been unsuccessful in many states except for Southeast Asian states. Excessive borrowing and current account deficits have occurred due to the rapid entry and exit of capital movements to national markets. These economic problems have led to financial fluctuations and crises in the global system. These crises are 1992 crisis, 1994–95 Mexico crisis, 1994 Turkey crisis, 1997 Southeast Asia crisis, 1999 Russia crisis, 2001 Argentina crisis, 2000-01 Turkey crisis, 2008 global financial crisis, and 2010 Euro crisis. For example, with the decline in housing prices in the USA in 2007, the value of the house owned by the borrower was reduced to below the mortgage loan, and the possibility of these loans not being paid by the borrowers caused economic problems. Due to this uncertainty, the desire of the investors to withdraw their capital, and the reluctance of the borrowers to pay their loans led to a liquidity crisis in the market. In 2008, this crisis spread to all world economies and reached to a global dimension. This financial crisis caused inflation in various states, increased unemployment, and reduced the economic growth rates. The main characteristics of financial crises. Uncertainty in the financial system changes expectations to a great extent. Financial institutions worry about cash problems. Decreases in profit will create a base for bankruptcies. Reduction of the portion of capital evaluated in real production. Not decrease in interest rates and contraction of economic activities. Deflation is the concept of continuous decreases occurring at the general level of average prices. According to a widely accepted approach in the literature, the types of financial crisis: monetary crises, banking crises, systematic financial crises, external debt crises, not technological crises. The first-generation models introduced by Krugman to the literature are aimed at explaining the monetary crises in the countries of Latin America. Third-generation models are the models that emerged as a result of increasing interdependence and economic integration, and is also referred as the Contagion crisis model. The factors that led to the economic crisis in 1929, according to the economist Fisher: sales made to liquidate debts and to make ends meet. Reduction of money supply due to non-payment of bank debts. Start of bankruptcies due to the decrease in the value of the workplace. Saving money and not making new expenditures. Not increase in asset price levels. The country that creates the Bretton Woods system to remobilize and stabilize the world trade is the USA. The two superpowers in the international system that emerged after the Second World War are the USA and the Soviet Union. The impact of economic crises on unemployment rates in countries. As a result of economic crises, a contraction in the national economies occurs. One of the factors that are negatively affected by this contraction is employment. Unemployment data is an important indicator of the state of a country's economy. In countries with economic crises, it is seen that the unemployment rates increase and the capacity utilization rates decrease. American economist Arthur Okun established a law on these two elements. There are two different forms of the Okun law, based on the relationships between economic variables. The first is on the relationship between growth and unemployment. According to Okun, a 1-point increase in growth rate reduces the unemployment rate by 0.5 percentage point. In other words, a 1-point contraction in the economy in countries where economic crises occur increases the unemployment rate by 0.5 percentage point. The second form of the Okun law is on the GDP gap and unemployment. According to this form, if the unemployment rate is 1 point higher than the natural unemployment rate, the GDP gap increases by 2.5%. Increased unemployment in the country after the crisis in the economy leads to a large deficit in GDP. The effects of the Great Depression of 1929 on Turkey. The Great Depression, which took place in 1929, had profound implications throughout the world. It had influenced industrialized countries more, primarily in North America and Europe. This crisis has caused various problems such as the decrease in production, shrinkage in demand, the decline in the prices of agricultural products, and the formation of foreign trade deficits. After 1929, all states had to reconsider their current economic structures, and the idea of the free market of classical capitalism began to lose its credibility. Turkey, compared to other countries, is less affected by the 1929 crisis. The impact was mild because the Turkish economy was not integrated into world trade, and the market economy had not yet developed in the country. One of the effects of the crisis on Turkey was experienced in the agricultural sector. Prices of raw materials and agricultural products decreased sharply. With this decline in product prices, Turkey's foreign trade volume also decreased. The fall in prices of agricultural products had also affected farmers. The farmers who had difficulty in making a living started to migrate to the cities by selling their land. On the other hand, farmers' inability to pay their debts to the banks had made the agricultural sector more distressed. Another effect of the 1929 crisis in Turkey had emerged as the balance of payments deficits and monetary crisis. The closure of small-scale manufacturing enterprises increased rapidly and the private sector remained below the targeted level in the direction of industrialization. Since 1933, Turkey has given priority to both industrialization and banking sector policies. After the crisis, Turkey started to implement various policies in its economy. The liberal understanding, which was effective in the management of the country, had been replaced by the principle of statism. The state decided to purchase directly from the farmer in order to protect the agricultural sector and farmers. In order to increase the use of domestic goods, the national economy and savings society was established. In order to maintain the value of the national currency, the law on the protection of the value of Turkish currency was enacted. Besides, the Central Bank of the Republic of Turkey was founded. The comparison of the November 2000 crisis in Turkey with the February 2001 crisis. The reason for the emergence of the November 2000 crisis is the congestion in liquidity. The fact that banks did not have sufficient foreign exchange surplus before the crisis, and the increased capital outflow to abroad, created the distrust in the economy, and this led the country's economy to the liquidity crisis. The reason for the February 2001 crisis was the deterioration of the foreign exchange market balance. Since the confidence of the citizens in the national currency was weakened and the exchange rate was expected to rise again before the crisis, a currency substitution was realized and this situation led to the crisis. The banking sector faced interest rate risk after the November 2000 crisis, and experienced significant losses as a result of both interest rate and exchange rate risk following the February 2001 crisis. The November 2000 crisis resulted in foreigners storming to the foreign exchange, and the February 2001 crisis resulted in all the account owners storming to the foreign exchange.